and welcome to Outlook Money's webinar series. This show is part of the Investor Awareness and Education Initiative spearheaded by Mirae Asset Mutual Fund and powered by Outlook Money. With me today is Mr. Mayukh Dutta, Head Product Strategy and Communication, Mirae Asset Investment Managers Private Limited. Mr. Dutta has over 23 years of experience across various financial verticals, including, of course, areas of asset management, insurance, retail financial services, and non-banking finance companies. So welcome to the show, Mr. Dutta.
Thank you, Nidhi, for having us today. I hope we have a good discussion.
Sure. And today's topic of discussion is asset allocation. And like most of us know, asset allocation is something that always needs to be the underlying philosophy of any investment, but it becomes especially pertinent today because the stock markets are so volatile. We all know that in the last 2 years post-COVID, there has been unprecedented numbers of people joining the equity market, and in this regard and in this perspective, this discussion becomes even more important so that people don't go maybe heavy on one asset class and ignore the rest. So in this conversation, Mr. Dutta will, of course, help our viewers and investors understand the nuances of asset allocation, so to say. So starting from the basics, Mr. Dutta, what is asset allocation and why is it important in portfolio building?
Okay, so Nidhi, it's a very simple thing. No meal is with only one thing to eat. Same as no education is complete with only one subject. So no goal can be achieved, and there is not by only one activity. So similarly, in a portfolio, there are different parts which everybody invests in for different objectives, and that's what simply I would say asset allocation is, where you have different investment into different investment vehicles with the purpose that the whole basket helps you achieve different goals. So it's a simple thing. If I have any goal, or if I have any requirement of money in the next 5 or 6 months, I would invest in a different manner. Again, something for which the money is needed after 3 to 4 years or 5 years or 10 years, or maybe 15, 20 years from now onwards. So naturally, different objectives will lead to different actions, and those actions are actually where we invest in, and therefore also, and by doing that, we are overall managing a certain allocation, a certain risk profile, which is being therefore achieved by asset allocation. That's how I would look at it. So different investment allocation actually leads to accumulating different asset classes, because each asset class has a different characteristic, and that then helps us achieve our goals. That's how I would look at asset allocation.
Right. Of course, that is a very useful thing that you just told our viewers. But another thing that people often say that asset allocation should also be dependent on the investor's age group, depending on the risk profile that different age groups are meant to take or traditionally take. So, what should be the ideal asset allocation strategy for different age groups?
So, I would say an asset allocation strategy is a very personal exercise. So because each one's requirement and needs are very different, everybody's income would be different, their age, their strata, where they belong from, their family background, all of that goes into an asset allocation strategy. Now, usually when it becomes very personal, one of the ways people would look at it is to club age groups, and therefore think that people in the certain age group will have a very homogeneous asset allocation.
Right.
That's an easy way of explaining asset allocation. Necessarily doesn't need that everybody should go through the same one. I'll just give an example. Somebody at the age of, let's say, 35 has a home loan, is running, or somebody has his own pre-owned home. So naturally their outflows are different and their investment planning will be different, because both of them may be of similar age but have very diverse requirements at a certain point of time when it comes to their investments. So I would assume, but if we were to take this, that no age should be one of the starting factors, then it becomes a homogeneous cluster of people. Then I would say that people who are slightly younger would technically have a longer investment horizon, and therefore they should be looking probably at an allocation towards the higher income or higher growth assets, and they tend to then probably have a higher allocation towards equities, just because of the fact that their time horizon is higher. And when time horizons are higher, equity could be a preferred choice. So I would say that's one way of looking at it. But I would still stick to the fact that asset allocation is it's a very personalized prescription which everybody will take for. Not same people would tend to have the same asset allocation just purely on age. Age is a good starting point, but there are many other factors.
Right. In fact, age is definitely a factor, like you mentioned, is one of the factors. But a lot of people end up actually looking more at the returns rather than what assets they are looking for, and they tend to allocate more in assets that are high performing, which we saw perhaps in the last year. So, do you think that could be a dangerous strategy, and could you explain how?
So I would agree that it happens every time, and especially now that it is coming out of a very high equity performance for the last couple of years, that which technically in behavioral is called behavioral finance, is talked as recency bias, that people tend to look at only the recent performance of any asset class and then base their investment decisions. I would agree with you that it looks slightly dangerous, possibly because this is not a long-term investment solution, that you look only at the past return, and that also immediate past return, and then make your assumptions that this is going to continue forever. All asset classes go through their investment cycles. That is exactly the reason why asset allocation should be there, because everything else goes through cycles. So therefore, you should have the diversification that you are able to go through that. So one of the ways I would say is that the better way is to look at what is that individual's needs, and when will that need actually turn out to be which requires a solution. So if I were to retire in 20 years and I need an X amount, so I will plan accordingly. Vis-a-vis, let's say my friend needs to have a similar amount, but he would need it in 3 years for his child's education. So if both were to look at immediately the recent past and place their investments, it would be a very different outcome for both, because the requirements are different and the time frame is very different. So I would say that just looking at recent past and therefore allocating high is not the right thing. There has to be a spread, and that spread will come out A, from my risk profile, and B, also from when do I need this money back. So a goal is a better way of looking, and the amount needed, when it is needed, how much is needed, and for what purpose, is very intrinsic. But that's a safer place to be there, rather than just looking at something, what is the fad or what is looking very great right now, and then placing our decisions. I would end by saying that it is also important to understand cycles when it comes to investments. All asset classes have cycles. So what is looking good has had also times when it did not look very good at all.
Absolutely.
So, and keep that in mind when you are doing your investment choices.
Right. So, goals and your needs are something that have to be, kept in focus. But when it comes to, say, asset classes like equity, you were mentioning that it is not very advisable to just look at the immediate gains. Would you have any time frame, or roughly the kind of returns that people should look at, as in the time frame for which the returns should be looked at?
Typically, we would say that if it's pure equity funds and equity as an asset class, I would tend to think that people should think in timeframes of 5 years and beyond, because historically, from when I talk about cycles, it's beyond 5 years and others where compounding and the impact of time starts playing out in equity returns, rather than looking at a short term. If it is lesser time frame, I would probably say that it is advisable, or probably it would be prudent to at least check hybrid funds or debt funds for short-term goals, and then look at that. Typically, a rule of thumb would be, if your goal is further down into with time, which is 5 years, 10 years and beyond, the percentage allocation towards equity or any growth oriented asset class could be slightly higher. But again, this is not at the cost of what is specific to a one person to another. Just because this is a rule or this is an observation doesn't mean that it is applicable for everyone. It is finally the allocation percentage will depend upon the person's risk profile, and what is their current state. For example, two people of the same age, but people having some, everybody has family liabilities, have other commitments which need to be taken care of. It could be emergency, it could be medical requirements. So what is left to be invested and when it is needed is more determining factor. And that is where asset allocation comes in. It's a left and right brain appeal about both sides. There is emotions involved. There are requirements also involved. Both need to be taken care of in that specific exercise of asset allocation.
That was an interesting example to explain the viewers about this pertinent point. But you also mentioned this hybrid funds and balance funds. Do you think that mutual funds that do asset allocation on your behalf, like these funds, hybrid and balance, are they? Do they really help? And what do you think should be the ideal strategy of allocation for these multi-asset funds?
Good question. So now we are getting into the technicals of which are the type of schemes and how do they help in. So I would say that these are allocation products by the scheme by itself. They have a certain percentage of different asset classes. Typically, a hybrid fund, for your viewers, is very simply is that one scheme which they invest into more than one asset class. So it could be one, it is definitely more than one. It could be two or three asset classes, because that's what the rule of the land allows those schemes to invest in. What they help is they are not doing asset allocation for the investor, because the investor's total asset allocation could be into different other asset classes, right? It could be your bank FD is also an asset class. Money lying in the bank account is also an asset class. It is earning something for the investor. Money invested into long debt products like a PPF or MyPF or any other thing, or an NPS, are all a part of asset allocation, right? So they become a whole part of a person's net worth exercise. So, but within that, there are these hybrid schemes are let's say a rule-based way of investing, that a fund will invest into more than one asset class in certain proportions. What it helps the investor is, it is giving a solution of participation, that by 100 rupees will be invested into, let's say, A asset class of an X percentage, into B asset class of Y percentage, and C asset class of Z percentage. So am I okay with ABC? Am I okay with XYZ? So to put it simply into another example, a fund can invest into debt, equity, or let's say gold, just for example, and it will invest 35%, 30%, 30%. So the fund is doing an allocation. Am I agreeable with this breakup of equity, gold, and debt, and the percentages? If that overall is helping me achieve a certain goal, multi-assets or hybrid funds then start making sense in the overall asset allocation. To that extent, it allows the investor the participation into different asset classes in that ratio. So that ratio overall comes to a certain X number. Is it helping me achieve my goals? Also, by doing that, one of the benefits is that it allows you participation. It also gives you a taxation benefit if it were in equity-oriented taxation. Had one to do it individually separate, the tax will be different. The rules will be different from a capital gains point of view. So that is where it helps an investor, and by some ways it helps for a larger set of investors, that some participation is happening in different asset classes. If I were to do it piecemeal, then I would have to do it separately. So for example, somebody were to buy equity different, were to buy a debt product different, were to buy physical gold different, just for example. So in a multi-asset, probably it helps them do all of that at one go, at one place. So that's a matter of convenience and participation.
But we are talking about convenience, and the general idea about hybrid funds is this convenience of allocation that you were talking about. But you also talked about you have other debt components in your portfolio, say your EPF or your NPS, etc. So would that become a little more challenging in terms of working out what your total debt allocation is, and then looking at this multi-asset fund on what the debt allocation is in this fund? So So how do you think that, that can be tackled when including these funds in the portfolio?
Now we are getting into the difficult part of the discussion. So I would say that when people look at their whole net worth, sometimes they forget to add on these compulsory contributions which they are making to their retirement and so on. While these are a part of anybody's, let's call it passive debt allocations, which happens over a period of time. So that should be considered when you are making your investments, but that should not also limit you from not getting into hybrid funds, saying that, oh, I'm already investing into PAF or EPF or whatever, or the other products and others, therefore I don't need to invest into these products. No. What happens is when you take these funds in a basket together, which is the hybrid fund or multi-asset, what it is helping you is that this model or this percentage allocation helps you reduce volatility in your portfolio. And that is one of the main reasons why anybody would look at a hybrid sort of product. Second part which it helps is that was somebody were to do this piecemeal, the tax implications will be different. Third part is there is a large set of investors who would like to have and prefer that they would like to have a set allocation going into their money. Somebody like me who would not have time would rather say, I would want to put some money into debt, some money into equity, maybe some into gold. I'm just saying, if not gold, then debt, equity. And I want a certain percentage which works in my favor. And I'm ready to give time. Maybe there a hybrid fund comes in because I would like to have the equity participation, because I would like to invest for a longer period of time, but I also would not like to have so much volatility in my portfolio. There the debt helps me stabilize, and therefore on a risk adjusted, I am slightly better because that is what I would prefer. My friend may have the same time frame, but he may be okay with volatility. So he would probably go for a full equity portfolio. So what helps is that, A, it gives you participation, and that participation helps you manage the volatility also, because debt and equity are there. The graph will look much lesser volatile than probably an equity will look like over a long period of time. So that is where I see a lot of convenience for investors.
Right, that gives an overall perspective, and like you've highlighted, balance funds are tax efficient and they manage volatility well. And a lot of people are in fact, looking to be in that space. Not everyone is comfortable with the risks that equities bring along. And in this regards, these funds can come in really handy. So thank you so much, Mr. Dutta, for this engaging conversation on asset allocation and shedding lights on balanced and hybrid funds that can be effectively used for an asset allocation strategy. And thank you so much for your time and for being here.
Thank you, Nidhi, and for having us here for this session. I hope your investors got some useful points to decide their asset allocation. Thank you.
Sure. Good day.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.